All right, we got a pretty obvious Elliott Wave shape here. To point out that I haven't seen any of the Elliott Wave guys talk about today, which I was surprised. But I'll cover it right now, and this could potentially be playing out after market tonight. And let's look at the Elliott Waves, and let's talk about this 200-day moving average up here, which is a massive bear market, bull market kind of dividing line. And we'll do the cyclicals, do some fundamentals. This is Brian Lewis with MMT Investing, and things just changed. So here we get this sort of head and shoulders looking pattern. And well, let's just do the bull. Let's do the bull scenario first, which would be that we just get up here above this moving average. So this moving average is roughly what contains bear markets to the downside, and it contains bull markets to the upside. And there are a couple of exceptions to that. It's not 100%, but it really is like more than 90% of the bull market is above this line, and more than 90% of bear market activity is below that line. And so approaching this line is a huge, huge thing. And it's not dead on this line. It's like right at 3,000, but it would be more of a zone, probably uh, a bigger zone to sort of differentiate, because you could get up here and still have bear market activity, or you could get down below it and still get back up for the bull side. But in general, for the bulls want to get up here above that moving average and then probably back test it from the top. And that would be the bull activity. And that would be the end of the bear market, and likely off to all-time highs in the bullish direction. If this moving average gets broken and tested, and so that's the simple kind of bull scenario. And the bear outlook that I was going to paint here is a little more complicated because it requires some Elliott waves and some technicals and some cyclicals and different things that we're looking at here. And so we can see this arc here. I'll get out here and look at this in a minute. But this is kind of our containment arc that we've been following on the cyclical level. And then here we have this head and shoulders looking pattern, and then this wave up. And this is called an expanded flat in Elliott waves. And you get a 1, 2, 3 up and a 1, 2, 3 down. That looks like a head and shoulders. And then you'll get a 1, 2, 3, 4, 5 wave up. And the 5 wave is generally roughly the same length as this one wave. And the rough math I did on this was about 2991 at about 11:49 p.m. Eastern time is what I was looking at for the sort of target for an expanded flat here. About midnight, yeah, about a little bit under the 3,000 here. And that would be a top target for an expanded flat, and that's a big time correction pattern. If we get an expanded flat or reversal, it should be a really aggressive down move from the top. And let's what am I out in 10 minutes? Yeah, let me get out to, I guess, hourly and take a look at this thing, and let's get this circle lined up. All right, so here's my arcing cyclical pattern that I've been calling the double rainbow here, because we're getting reactions around the outside edge of this, and then we get reactions to the inside, and it's been kind of bouncing back and forth on this arced pattern here, and we really didn't get a middle bottom in this cycle. And so the look for this cycle is that now we have this first big credit drawdown, and that sets up a credit contraction cycle, and that's usually roughly a 3-month cycle. And this one is looking to be slightly more than 3 months, pretty close. And quite often you'll get a middle bounce down and back up in a cycle like this. And we're getting this smooth arcing top, that happens occasionally. You see this rounded top, and so I get the ellipses here containing this. And then you can see here we were reacting outside, crossed over, and then we've been reacting on the top and this down edge here. And if we take a look at the reaction patterns, this follows it, and this grinding action follows that angle of the circle or the ellipse here. And then when we get this W bottom, this W grinding action sticks to it at that angle. And then the top on this one is at the same angle, the grinding action on the top here. And then here we get our first downward angled grinding action here along these at the angle of the circle. And then once you get up here, you can see this top, this head and shoulders kind of top that we get is along this angle here. And now we've gone out of the top of the circle. And so now we are wondering what's going to happen. And we have this exponential moving average, this 200-day average up here, which generally will fully contain bear markets to the downside. And once you break above that thing and get up, that is a bull market signal. So this is a huge area here. And on the cyclical level, we're just kind of looking for a downward movement towards the end of the cycle, which would be sometime around the beginning of June. And so this movement up outside of the arcing pattern here is dramatic. And for the bear, I guess, targets, if we get an expanded flat reversal on this one, I would imagine we're trying to get back into the circle. And so I guess like an optimal bear target for shorts off of this would be just to get right back down here into this line and probably hit it twice and kind of grind along it. And there would most likely be a back test on the way down. And so that's kind of like a best case bear target here. And then just the general bear idea is just to get back inside this circle and possibly back test this thing. And then any kind of activity in this zone would be pretty normal bear activity that would be just sort of headed towards the end of the cycle. And there's no exact end date or anything on this cycle model. I mean, this is June 5th to 12th. Yeah, so the end of the cycle looks like this whole range here could be a target for the end of the cycle. And we're kind of on the cycle looking for a reversal pattern out of the cycle where we would get credit contraction activity in the downward direction, and then maybe a consolidation zone reversal, like an ending diagonal kind of Elliott wave shape out of here would be a high volatility and easily to recognize shape. But you could also just get like a big W shape reversal or something like that, and that could happen a little bit earlier up here in this kind of area, or that could possibly retest the lows and finish this circle and get out here and possibly get down to some kind of retest down here. All we have right now to work with is just this circle shape and a very vague idea that the end of the cycle will be sometime in the next couple weeks or the next month. I mean, what's it now? The 21st, 22. So, I mean, yeah, maybe 2 weeks, 2 to 5 weeks kind of outlook on the late cycle activity here. And then on the fundamentals, it's getting kind of crazy. I mean, we have projections for negative interest rates, which is a deflationary signal that would be very good for gold. And that would be very, very bad for banks and financials. Oh, where'd I go? Oh, okay. Yeah, so that would be really bad for banks and financials. And negative interest rates would, on the international scale, would most likely set up the situation where you have the dollar losing value to gold, and then you have the other currencies around the world losing value to the dollar. And then the deflation scenario would mean that commodities worldwide, and that's what I mean by deflation, not like the price of food in America, like the worldwide economy, the price of commodities would be even lower than those other currencies. It would be dropping relative to their own currencies, and that that would be a deflation scenario, which could be really really rough for the worldwide economy and also America. And the stock market's not directly tied to that, but deflation in worldwide commodities should result in downward movement in the U.S. stock market as well. And so those interest rates are very, very important to watch on the monetary system kind of fundamental level. And then we've had a bunch of big news. I mean, the Fed has put out reports that they're going to provide as much liquidity as necessary, and so there's not really a liquidity issue anymore. And if we get downward activity here, the Fed is going to come in and pad that, and then the real issue is not liquidity at this point; it's solvency. So just making the banks functional does not give all the companies and the households in the world the ability to pay their bills. You need cash flow in order to pay your bills, and that's when companies start getting in trouble in this deflation scenario, is when they have solvency issues and they can't pay their bills, and that's when you have bankruptcy kind of outlooks, and that's how it would start affecting the stock market if we got into a deflationary scenario. But then there's the sort of inflationary outlook where probably the other world currencies would still devalue faster than the dollar would, because we have a dollar standard. But in that case, gold would probably still be better than dollars, because dollars would be devaluing, other currencies would be devaluing. But in the inflationary scenario, you have the currencies devaluing faster than the commodities, and so the commodity prices would be rising, and that would be beneficial to the stock market. And in that case, the interest rates would probably be rising. So that's a huge signal to look at, as if the interest rates are dropping, that's pointing at a lower, longer recovery. And if the interest rates are rising, then that's pointing to an inflationary kind of recovery. And inflation would send the stock prices up higher, and deflation would be a downward pressure on the stock market. So that's kind of the fundamental outlook. Over the next several years, but right now we're just kind of in cyclicals where we have an outlook for the end of this credit contraction cycle here to be, happening over the next 4 weeks, maybe the next month or so. And after this credit contraction cycle, then we're looking for some kind of reversal pattern, and then a should be a strong third quarter this year, with an monetary expansion phase that would be pushing up against the overall kind of structure that we have on the backside of this bubble, which looks to be trending to like a deflationary outlook. And so you have an expansion inside of a larger contraction. So just sort of an upcycle, but sort of a dangerous one. And it should be about 3 months of less crazy and just general upward movement after we finish the sort of probably be some wavy volatility on a reversal pattern. And so that's kind of the cyclical outlook, is looking for the sort of bottom reversal pattern on this cycle, and then getting out into the next couple phases. And it looks like 3 quarters in a row of monetary expansion cycles, based on financial data. And it looks like upgrowth and then downgrowth and then upgrowth throughout those cycles. So maybe kind of like a wavy S shape. And in a deflationary environment, it would be a wavy S shape that doesn't go very high. And if it's inflationary, that would be a wavy S shape that goes way up in the stock market. But I think in either case, it should be an upward movement for a while after you get out of this contraction, and just trying to follow exactly how to position on this contraction because these contraction cycles are extremely difficult to trade. You get volatile, crazy movements, and you can have big sell-offs like this thing, and sometimes you get three different kind of sell-offs in the one cycle, and we got a huge one at the start, and this just sort of gentle, rounded pattern. But there's a high probability as far as the cycle goes that we get another downward movement here, and yeah, and then sort of, I guess, back on the fundamentals. I mean, you see Warren Buffett selling his banks now. So he sold Goldman Sachs this past week, and he's trimming shares at JP Morgan. And he sold some other stocks like Phillips 66, Travelers. He sold all his airlines. So Warren Buffett is expecting a deflationary scenario. It seems like from his moves, and he wants to hold dollars through this thing. And so yeah, I guess I could get a little bit into strategy. This is not investment advice. And please hit the like button and stuff. And then I have playlists with a bunch more information like this, kind of financial education playlists if you're interested in more financial education stuff. But just fundamentally, the the price to earnings ratios on most all of the stocks in the stock market are just nonsense high right now. Just really, really bad from a value investing perspective. So, I mean, Warren Buffett as a fundamental value investor is just like the value on all of these things are terrible, but he loves his banks. I mean, he has primary banks, and those have been his main stocks forever. And he's selling his bank stocks. That is a huge indicator that we're kind of going through a financial change where banks will potentially be unprofitable. I mean, if the deflationary scenario happens and we have low interest rates, negative interest rates for the foreseeable future, then banking becomes an unprofitable industry, and it makes things really complicated in the international monetary setting. And we see the Fed stepping in and creating all these programs now to sort of do the job that banks are failing to do now. And it seems like they're doing a pretty good job of it, and they did a pretty fast response, and things are functional again. But the amount of money they're creating now is potentially smaller than the amount of money being destroyed out of the international economy due to the contraction and the soon-to-be solvency issues that are coming up. So it'd be a really interesting thing to see how much the Fed is going to print, and then how much the other countries are going to print relative to the Fed. And basically, all the U.S. dollar is like 70% of the international currency system are dollars, and then there's a chunk of that. The other 30%, you have euros and yen and Chinese, and all the other world currencies just make up small percentage of the international system. And so when the Fed goes to print, $1 trillion, like that's $1 trillion against the entire world dollar amount, which if you ask Luke Groman, says that could be like 100 trillion across the whole world. And, so 1 trillion is just 1% of that huge number. And, if Europe or China or Japan, those bigger ones, printed $1 trillion worth of their currency, like that's relative to their 10% or something. So that would be a huge amount relatively between the dollar and their currency. So that would be pushing the DXY up. And that looks like a high probability trade over the course of the next maybe couple of years, is that the US dollar, not necessarily just the DXY, because the DXY is the dollar against the whole basket of currencies, and the euros are really big in that basket. But if you look at dollars versus specific countries that have high debt or that are commodity based, um, like Brazil, for instance, I can do a list of these later, but um, that's gonna be a very interesting trade over the course of this. sort of solvency issue where countries are going to have to inflate and sell their commodities cheaper and cheaper to just cover their debts. So you would have the deflationary scenario where commodities are lower than the currencies, and those currencies are lower than the dollar, and then gold would probably be higher than the dollar in that scenario. And so yeah, for deflationary scenario, gold would be very good. And then for the inflationary scenario, where the governments are printing a lot, um, but commodities are going up, that would be a really good scenario for silver. Because silver is a monetary commodity. So if the commodities are going up and the currencies are going down, that would be a killer environment for silver. So gold and silver are very interesting here, and bonds in general should go up as the interest rates drop, and then the currency exchanges between the dollar and other currencies, like the dollar can absolutely crush certain other currencies that are high debt, like India or um, I mean, China is definitely an interesting one, but they're a special case. And then countries that are commodity based currencies like South Africa, that I'm in now, or Brazil is one that has already started going down dramatically. And then like Canada and Australia are commodity currencies, but they're bigger economies that don't look to be in as much trouble as some of the emerging market commodity currencies. And so those are all big looks. And then the potential breakdown of the European Union, if that sort of happens during this backside of the bubble, then the dollar versus the euro at some point would be a huge trade. So that's a look at the world monetary kind of currency to currency outlooks, and how to look at the interest rates and how to use the interest rates to kind of forecast the inflation or deflation relative to world commodities, and that would be affecting the stock market. Um, but the stock market is still complicated relative to the international, like the U.S. stock market relative to the international financial situation is one step removed. But if you follow the cyclicals and follow definitely the interest rates and the bonds are a big thing to pay attention to, just to kind of see the outlook on on how things are trending. And let me I don't know. I think that's probably about it for this one. I lost my moving average, but it was in this area, and we're getting really close to it. And so the moving average, we broke underneath it here, and it's coming down pretty close to the action here. And so for the bear market to continue, which it seems fundamentally highly likely, especially with this blow off top, and I'm calling this the everything bubble blow off top, that we do continue a bear market and activity here where we are backtesting these long-term trend lines. I mean, this is a two-year angled trend line that backtests and gets off the Volmageddon sort of bull market line. And now we're testing across the 2008 financial crisis line. That's a 12-year long trend line that supports the entire bull market up from the financial crisis. And then we have another line way down here around like 1200-ish, and that is the floor basically of the everything bubble, which starts in 1982. And the long term bull market line for the entire everything bubble is like 40 years long, and this is it, and we're way up above it right now. So looking out maybe 3 years or something like that, 2 or 3 years, I guess. If we do get a really aggressive contraction, deflationary cycle, if bond rates go negative, or I'm sorry, if interest rates go negative, this is sort of a downward target on the entire everything bubble. That would be a downward target for a deflationary kind of stock market crash. And Yes, and right now we're just in the middle of a very complicated cycle here, and hopefully we switch out of here and go into some easier trading environment where it's a little bit more predictable and longer term and less volatile, um, but still keeping in mind the interest rates very important. If the interest rates start trending up, then that is going to be bullish, and if the interest rates start going down more, that's going to be bearish. And I guess it'll pretty much show you what the shape of the recovery is going to look like just looking at interest rates. And yeah, if we get the yield curve to like the 2 year, 5 year, 10 year, the 30 year bonds, the interest rates on the bonds, the U.S. Treasury bonds, if those get vertical where they're increasing and the bond curve looks normal, but those interest rates are negative, that would be the deflationary outlook, and that would be a very dangerous time to be holding stocks at that point. Um, and so that's kind of the stuff to look out for here in the very short term. I mean, right now overnight, just a little Elliott Wave kind of reversal pattern to see if that happens. And then we have a big time 200-day moving average running through here around 3,000. That keep the should keep the bear market activity underneath, or if we get on top of that, should keep bull market activity above. And so that's a really big one to look out for. And so that's all the stuff. Basically, the cyclical the cyclical outlook based on just inflation, sort of in GDP growth, which is what affects the bond rates and the interest rates. And that's generally, I mean, that's generally what you use to predict when these kind of cycles are switching. Just looking at inflation data and growth data, and right now it looks like inflation and growth data are still on the down and should be switching both growth and inflation on the up soon, in about a month or something like that. And so we'll be watching out for all that stuff. And yeah, and then we can get back to building the shape of this model. If we get a turnover kind of edge on this thing. So yeah, I guess if you have any questions, just let me know. Just covering kind of the general macro outlook on this one, and it'll be very interesting to see what we get overnight here. And as I scroll, it destroys my circle, so I have to kind of leave it where it is. Um, but that's kind of the look. Oh, and I can do the MACD kind of cyclicals and kind of see where it looks like we are on the MACD. So if we go out to weeklies, we are in bear territory, but it's trying to pull up and get less bearish here. And then if we go to the dailies, so the weekly is kind of a year over year kind of long-term look, and the dailies is kind of the month to month. And we have gotten up into bull territory here, and it wants to go up more. So this is a really bullish outlook on the month to month here. And 4 days, this is bullish and trying to go up right now. And 3, bullish and kind of stalling out. And bullish and little tiny bit bullish and stalling out hourly. And then kind of coming into the trading over tonight and tomorrow, it's looking slightly bullish and kind of stalling and stalling and neutral. So we have a longer term bullish look right now, and not much information on what it's trying to do immediately tonight from sort of the cyclicals. But we do have this Elliott Wave shape that is quite possible, and we'll see if we do in fact get another wave up tonight into this expanded flat reversal pattern. And this is not investment advice. And then, yeah, I think I already mentioned the playlists, and whatever you guys want to see, let me know. Um, there's a really good special. Raul Powell has been working on his sort of thesis for this entire new market setup, and interviewing people and talking about the deflation scenario, which is commodities price dropping faster than their currencies. Um, and that and that scenario presents some pretty interesting things that I was just talking about. But I'll do a I'll do a Raul Powell episode here, kind of a long one, similar to this, I suppose, that talks about all of those macro ideas on the world economic scale, but then also looks at the actual trades and how to do them, and hopefully when to do them, based on some cyclical things, which would be a pretty cool sort of playbook to have over the next 2 years, just for some basic sort of macro trades. Uh, if the stock market is just crazy, that those are a bunch of trades that have to do with the macro environment that aren't necessarily in the U.S. stock market. And so that's what I'll have coming up here soon. And let me know if you have any hot stocks you want me to check out and do some analysis on. And happy trading.